This conference will now be recorded.
Good evening, ladies and gentlemen. This is Clueless Trading Frank. It's approximately 8:35 p.m. on October 27, 2019. We're coming to the end of October. Happy Halloween, guys. And this session is a strategic weekend update webinar. Lots of valuable information will be delivered tonight. So please focus, listen with your ears open, and see with your eyes open. And you're going to be totally prepared, in my opinion, to a large degree of what's coming in front of us. We're going to try to do some macro predictions, what will happen over the next, not just couple of days, over the next couple of weeks. And we are going to look at a couple of stocks, and we're going to try to wrap this up within 60 minutes because I really don't want to keep on going on 90 minutes and stuff. It gets a little too long, exhausting for me. It's going to be a big week, guys. So get ready. You're going to make some serious money if you do the right thing. Now, right thing doesn't mean you're going to be right every 5 minutes. It means you're going to be right overall on that particular trade. It doesn't matter if you miss a 200% type of options trading, a move that we show quite often, as long as you catch a good 60 to 70% of that. That's great. No complaints. As long as you're in the trade. That's how you learn. You got to have skin in the game. Trading is not a spectator sport, that old cliche. It is not a spectator sport. You do not want to be a Monday morning quarterback. You want to be on the field. On that note, full disclosure, this is purely for financial education and not for any solicitation or advice. We shall begin. So let's dive in. First of all, before we get into the charts, this is another heavyweight, monumental week for the stock markets, not just because of the earnings. I heard on Bloomberg this evening as I was having my keto diet, my keto sandwich, which was delicious, a wrap, I should say, and that almost 40% or 50% of S&P 500 and overall companies have reported, and more than 70 to 80% have beaten the lowered estimates. And yet, 99.9%, as I love to say, of Wall Street, retail investors, hedge funds, and the overall sentiment is bearish. God bless America. Let them stay bearish. The more scared they are, the more bearish they are, the more so-called neutral, aka bearish they are, we're going to continue. The bull will keep snorting. Now, that doesn't mean that it's going to be a constant straight line up, but I'm talking the overall general trend in the market. As long, and that's one of the key components, just so you all understand, behavioral economics, behavioral game theory, behavioral finance, whatever you call it, with quote more than $7 trillion cash sitting on the sidelines, with negative bond deals in Europe, with huge amounts of money sitting in government bonds, which are now losing value, and we're going to look at that tonight, as the yields are climbing, their prices are dropping. You are going to at one point have a sector rotation. It doesn't have to be a full sector rotation out of the trillions of dollars in the bond market, fixed income market, that is in many cases stupidly sitting there and caused for the demise and the Armageddon of the global economy just a few weeks ago, right? Exactly. Even a part of it moving out and entering the equity markets will be huge. It hasn't even started, guys. It's just the first moves that we're seeing. These are broad concepts. I'll try to explain them very simply, and we'll move on. So first and foremost, this is the week we're starting, Monday, October 28th. Oh, before I go any further, these things are very important. And please, this is just a request from me, but it's an important request. Number one, when you go through the real-time Twitter feed, which is our content delivery system, okay, where we have alerts, where we have charts, we have money-making actionable ideas, all kinds of stuff, some feedback sometimes from members, couple of fantastic motivational stuff that I believe in that I put out there at the end of the day, not in the middle of the day. Okay, this one I love. All this stuff. Just take a millisecond, like the high frequency trading computers, to hit like. If you don't like, don't do it. But if you like it, move your, just whatever device you're on, just hit like. Now, why is it important? Because if I see a lot of likes on any particular post, S&P charts, E-mini charts, Tesla charts, all this stuff, then I know that I should be maybe, this feedback is important because it helps my content improvement. Maybe I should focus on that a little bit more because that's my way of reading in a way that, okay, you guys are liking that. That means you probably have a position in it or consider going in there. So it doesn't hurt to hit a couple of likes. I'm not doing this for a popularity contest. It's for content improvement. So please do it. Second is our Instagram account. It's phenomenal. Look at those highlights of some of the trades that I put out there. Some of you have found us on Instagram, some of the newer members, and have come that way. And it doesn't hurt. Just create an Instagram account. Some people say, oh, I'm not a social media person. Neither am I. Do you see my picture on Facebook? So bottom line is the Instagram account is important for content, for promotional purposes, getting the word out there, and most importantly for active traders, non-active traders, whoever's a member at Clueless Day Trading, you can see the highlights of some of the actual options chart. Because when options go from 6 to, let's say, 15 or 6 to 9 or 6 to 8, yeah, it's numbers. Okay, yeah, it's 50% higher, 25% higher, 150% higher. But it's exciting to see it in a chart format, which I don't have all the time to do during the day. So please go to Instagram. If you don't have an Instagram account, create one and follow clueless8_trading. We also have a Facebook presence and a LinkedIn presence, and I copy and paste the strategic videos and such on that so that the word goes around a little bit. Stock Twits, I have a huge following, close to 33,000 followers. I don't even post there that much. But I love the venue. I think it's a great source of getting a lot of information, garbage and real information. Lots of great traders on there, lots of just complete idiots on there, but that's life. So nothing wrong with that. I think Stock Tweets is a phenomenal platform. In fact, my service was born because I was pushed by many. At that time, I had 8,000 or so followers. And back in 2014, they literally pushed me and said, you got to open a service. We need to know why you're hitting these things. Because I was active on there just showing the charts. I don't like writing a long-winded story like many people do. And the service was born. I don't want to do this extra work. I love trading my own book. You know, to be fixated on the computer and creating real-time posts that in many cases for me is pretty obvious is a lot of work, guys. These type of markets is a lot of work. And I didn't need to rely on the service. Some people, you know, there are many other services out there who are just service oriented. They're like, okay, it's a trading subscription service. That's what they do. My main book, my main income is my own trading book, my family money. And the service is a secondary thing, which I deliver phenomenal and supreme content. So that's it. You can follow me in Stock Twits too. But Instagram, and most importantly, hitting the like button on the real-time content feed is important for content improvement. And Instagram, so that you guys can see with your own eyes on trades that you might have been in or trades that you might have missed. That excitement and confidence when you look at some of those things will hopefully push you to get into some other trades, which will do the same. So please comply with those. And the third and the final request is we rely on referrals. We don't do wild marketing. We don't put out banners saying, hey, we're going to make you a millionaire in 2 days and all that garbage that you see in many, many other services when you go on their website or all the banner advertising that they do across the internet. No, we don't do that. We go word to mouth. And at this point, that's great. I'd love to have 1,000 members. In fact, we should have 1,000 members with the type of content that we're delivering. However, it's word to mouth. I like it. We are very personal. We like to help people one-to-one as much as we can. So we have a great community. We need to grow it. So please, referrals, put it out on your Facebook, whatever. Check out Clueless Day Trading. It doesn't hurt. It actually helps you because the larger our community grows, we'll have more interaction. And I think that will be a positive reinforcement to all members to have people like they were like till about a year ago. There were a lot of people in the chat room. And as the market whipsawed and stuff, it's just human thing, right? They all kind of filtered away. Now, most of our traders are full-time, they're full-time jobs. They are not day trading, day trader type, but I'd like to see the chat room a little bit more active, asking me questions. I remember at one point there would be 30 people in the chat room. And it was fun. It took a lot of my time though, so I don't mind the fact that the chat room stays empty during the day. But anyone can come in there. So come on in sometimes if you're free and chat with other people. You can send private messages directly to other members who are in the chat room. And I remember it was back in the days, till about a year and a half ago, it was really busy. But it took a lot of my time because I would answer the questions, blah, blah, blah. Some people were, like the diaper type of babies, they'd be like, oh, what do you think it's going to do in the next 10 minutes? Okay, great, So, but it was fun. So feel free to use the chat room too to ask me any direct questions or DM me directly on Twitter if you have a specific question that I can answer within reason. So that's all. Please, let's grow organically and let's grow together. So let's kick off with the economic calendar. Hi, Mike. Welcome. And let's look at the most important thing that's going to happen this week, which I talked about before, which you can't miss because either the market. That is the FOMC meeting right there at 2 p.m. Right? This is the Fed meeting. I believe there's one in December, but this is a critical one because the market would like to get another 0.25 percentage point cut. If the Fed gives a 0.5 percentage point cut and indicates that that's the end of this rate cutting cycle, the markets will pop up for 3 minutes and then crash. You have one of those intraday flash crashes. You'd rather have a Fed which says, okay, here's another 0.25 point cut. This is what we're looking at. Things are starting to get better. Looks like President Trump is doing the right thing with the Chinese trade negotiations. China over the weekend announced that phase 1 is almost complete. What great news. Fantastic. This is what I've been talking about. That this is what it comes down to. There were too much to lose on both sides. So aside from all the political rhetoric from President Trump and all the grumbling and complaints from the Chinese side, they got their heads together. So hats off. So now, phase 1 is going to be signed sometime in November at the APEC summit, the Asia Pacific Economic Conference, APEC, in Santiago, Chile. President Trump will shake President Xi's hand. They'll sign the deal. What a great sight. And every single skeptic will keep on saying the same thing. Go to StockTwits, go to other platforms where the chat rooms and stuff, public ones. They're all like, it's all garbage. It talks like that. Right. I'll take garbage, which makes the market go higher. Hostilities have calmed down. Just use the stock market as a behavioral phenomenon. You had a big fight with your neighbor, and now tensions are a little bit lower. You're not like throwing rocks at each other's window. You're not swearing at each other first thing in the morning. So you don't think the neighborhood is going to be a little bit calm? That your kids are not going to be scared every time you poke your head out and swear at your neighbor? Now you're not doing that. You actually shook your hand and said, listen, all right, we're going to work on our differences, on whatever neighborly differences we have. That's it. Economically, we are economic neighbors. Not physically, but, So what's the big deal? What's so difficult to understand? Now, unless things go heat up again, we're good. So I'll take what's happening in front of us. But the declaration and the announcement from China this weekend that the phase 1 is going very well, almost complete, is a very good comment. That's it. So Wednesday, mark on your calendars, please. Anyone can access econoday.com. It's free. FOMC meeting, 0.25 percentage cut with a somewhat dovish to accommodative. Simple English means that, okay, we're going to make sure. We said that many times, and Wall Street likes to play games all the time. So does the commentators. And hopefully President Trump doesn't keep on bomb blasting, Jerome Powell. He should have actually, like I said on my Twitter feed, he should have actually thanked Powell for cutting rates last time. And or reinforcing that he's going to cut rates again. Instead, he's telling them they're a bunch of morons. I don't get that. That part of Donald, I just don't get. And I get it. I know he's kind of using the bully pulpit to make sure that the rate cut comes through. I'm all for it, but to name call the Federal Reserve Chairman and other people, unacceptable. I'm sorry, unacceptable. So Hopefully he'll pipe down and not put out some nasty tweets. If he cuts the rate 1/4 percentage point, goes, oh, we should have gotten 1/2 percentage point. Okay, yeah, right. I mean, how much can you cut rates? Down to 0 again? Yeah, great. So, FOMC meeting announcement, FOMC chair press conference. This is the one that the markets always worry about because Jerome Powell is a complete nerd. And he sometimes trips up on what he says. And the markets act like crazed monkeys. So the 2 p.m., hopefully we get a rate point cut. If we don't, the markets are immediately going to fall 400 points. I'm telling you right now. Okay? Because it's built into the market that he's cutting rates. The Fed funds probability is at 60%, if not higher. That's a high number. So if we don't get a rate cut, 1/4 percentage point, the markets are going to fall. We have to get protective prior to this. And of course, I'm going to guide you guys as much as possible. We need to reduce long positions before Wednesday. Now, whether the market bounces from other technical levels, if it drops, we shall see. Depends on the tone and the wording and the verbiage of Chairman Powell, the most important financial person in the world, as to how he answers questions at 2:30 p.m. So, ladies and gentlemen, I'm warning you that if things don't go and he bumbles and messes up some of the answers like he's done once or twice before, even after he gives us a 1/4 percentage point cut, you see the market be extremely volatile to downwards. We are short-term overbought. There's no question about it. The VIX is at seriously low levels. So we will buy some protective calls by buying some calls on the VIX and possibly a little bit of insurance by buying some puts, what we call hedges on the SPY. Overall bull market is very strong. I'm going to show some charts which I looked at tonight as I was setting up. There you go. This is the most important day, Wednesday. The other most important day of the week is Thursday, October 31st. Why, Jen? Why?
I don't know, Frank.
No? You like a pumpkin?
Well, other than it's Halloween.
Exactly. It's Halloween, baby. All right? Halloween's a happy day. Lots of
close their book.
I'm sorry, what?
Profits for the year.
What's for the year? Oh, yes.
Funds declare the profits for the year.
You are dead right. I totally forgot for a minute. I've talked about it before. Thank you, Mike, for reminding me. It is the end of the fiscal year, not calendar year, end of the fiscal year for mutual funds and other large money, primarily mutual funds, which are the 800-pound gorilla in the market with trillions of dollars under management, and hedge funds. So yes, exactly. So October 31st. So obviously there's going to be on Thursday being the last day of the month and the last day of the fiscal year for mutual funds and other money center type of money management type of large outfits. You could expect to see some sharp intraday volatility as they balance their books. Thank you, Mike. Right.
Hey, Frank, also Apple will move the market when it reports on Wednesday night.
Yes, there you go. Facebook, Apple will certainly hit Wednesday night. So we got a big week here. Yes, because I have the whole earnings thing printed out. I use primarily briefing.com. I use Benzinga too for my service. So I just printed it out. So I'm going to highlight that and show up the thing. Yes, Apple. And Apple, it's 800-pound gorilla. So big stuff. So we start off Monday with nothing special. Okay? International trading goods, all this stuff. Nothing special. Here we have the FOMC meeting beginning. That's the first day of the meeting. It's a 2-day meeting. The core logic Case-Shiller home price index is important. Unless there's a dramatic change, it's fine because home builders do get affected by this. Consumer confidence, very important. We want to see it similar to slightly higher. Pending home sales index, doesn't really matter. And then, of course, the 4-week bill announcement and all that stuff, bonds. Employment report, important. GDP, very important. Now, Wednesday is really taking on a life of its own. Maybe we shouldn't do it. Maybe we should just like sell everything tomorrow when the market's up and just go and just sit there. So Wednesday, hey, it's going to be a smart move because it's going to be choppy, but we're going to have our charts to follow. So you got the GDP, wow, consensus right there. The consensus, not the final report. So, and then the gross domestic product, that's what the income for the US is, right? What they produce. And then you got this. So Wednesday is leading up to Wednesday, very important. Then comes Thursday, Halloween, obviously, end of the fiscal year for mutual funds and hedge funds. I'm not sure about the hedge fund part, but I know about the mutual fund part because I started my career as a junior analyst at Putnam Investments in Boston, right next to Fidelity, Post Office Square. Any of you know Boston, you know very well what I'm talking about. Beautiful area. And then of course I moved down to Wall Street a bunch of years later. So anyway, so lots of stuff going on. So some of the volatility that you see in individual stocks are those mutual funds and hedge funds balancing their books anyway, as we led into this during last week. You know, like sometimes, you know, you see some of this down, like what's going on here? Like nothing, you know, it's just they're probably balancing their books, selling, buying and selling and positioning, position sizing, doing all kinds of stuff. Then you got the employment costing that's important because that's an inflation number we need to keep an eye on. We have the Chicago PMI, very important. We need to have that close to, I mean, obviously I don't have the exact number, but if you click on this, by the way, it will show you, we'd like to see it above 50. That's expansionary. And then, of course, you got a lot of little T-bills and stuff, bond stuff. And so this is important. Friday comes about. By that time, we're all exhausted. We're like, please shut the market, you know, and hopefully we had a profitable week. We have the PMI, Purchase Management Index, inflation number, very important. Construction spending, important. And then we got some Fed speakers, John Williams, Clarida. And if I remember correctly, John Williams is kind of dovish. In other words, he likes rates to be cut lower. He was, I think, one of the early callers of cutting rates instead of raising it like last year. And that was a mistake that the Fed had made, the first rate hike, in my opinion. So they took it back, and now they're giving us a couple more rate cuts, right? So that's it. So it's a busy week coming out. Lots of earnings, not just Apple, Facebook. We're going to have an earnings bonanza, guys. And hopefully this time, you guys will buy one or two of the basket stuff. We got AT&T, which we are positioned long through Lottos. We're slightly down on that. And AT&T, we're going to take a quick look at the charts today. I like it. It's a very slow-moving, boring stock, but those Lottos move. We have made money on it 2 times, and a 3rd time round, we're down on it, at least on paper right now. Elliott Management is in it and believes that AT&T break up value with their asset sales and stuff. Well, whatever they do, it's financial engineering, should be a $60 stock. That's coming out of Paul Singer's Elliott Management. And please look Elliott Management up. So I got it. Hats off. We got a lot of companies. Wow. I have 13 pages in front of me of earnings. So I have to be very selective on the ones that I'm recommending, suggesting. Wow, 13 pages. So it's got to be the busiest earnings week coming up. So I'm holding literally 13 pages. Wow. Last week, just so you know, thickness, and volatility in the market, we had 8 pages. I had 8 pages of earnings. Not that we did all of them. We did, I select them and I show you the ones I think would work. And this week we have 13 pages. Wow. All right. Let's move on. Thank you for the feedback, Mike, Paul. And these are a couple of things that I want to show, and then we're just going to whip through it. Futures up roughly 5. That's good. I'll take that as long as the directional bias is good. What color is this? It's blue. Let's make it yellow. So this is a chart that I'd shown a few times. I don't do it every day. This is your 10-year government bond deal. I don't want to get into the intricacies of like what the bond market, this and that. This is your 10-year government bond. Our the ultimate safe security, like the 30-year bond. This is the 10-year. The 10-year is important because most of our consumer rates, credit cards, mortgages, all that stuff is tied in one of the major components is the 10-year yield. It's somewhere in the middle of the long yield, which is the 30-year, and the five-year bond, which is the shorter end, the 2-year and the 5-year, 10-year, in the middle, right? We don't have a 100-year bond yet, even though Secretary Mnuchin has floated that idea, which wouldn't be a bad idea, actually. 100-year bond to finance lots of infrastructure projects and stuff like that. Why not? So, real simple here. When this was down here, this was in this range here. You can go back and look at my videos, and I mentioned the TNX in it. I was starting to see a pattern. We moved up very nicely till about September, but this acted as a major neckline resistance at around the 1.875%. Remember, it's not 18.75%, in which case we'd be living in caves right now. It's 1.875%. You have to move the decimal to the left. So why to do that? I have no idea. So I'm sure there's a reason, and somebody knows it. I don't. You know, why don't they show it as 1.875, 1.777? You know, I have no idea. So bottom line is that this thing pattern-wise is telling us that it wants to go hit that neckline again, which also happens to be this long-term downtrend that goes all the way back from November of 2018. Okay? So if it attacks this and manages to somehow vacillates a little bit here and break out, and hits like the 2%, the market, there's going to be money. Remember, bond prices go down when yields rise. It's an inverse correlation, okay? So as yields are rising, and yields have risen quite a bit, the low on the yield was 1.42%. We are closed at 1.777. It's like buying a stock at $1.42, and then it goes to $1.77. It actually went to $1.875, 1.875. So let's look at it this way. That's a 45-cent move off 1.42. That means it's up 32% net percentage terms from here. So the reason I mention it like a penny stock so people can relate to it easier, imagine buying something at 1.42 and now it's at 1.77 or 1.875. That's a 32% move on the stock price. So as the yields go higher, these are big macro asset, trillions of the bond market is, I don't know, 20 times bigger than the stock market. People don't realize that. The stock market's like an iceberg, you know? The real iceberg is underneath the water, 3/4 of it. The stock market is what you see on the top. The credit market is what's at the bottom, which includes the government bond market. All right, just keep that in mind. So bottom line is when that iceberg starts to crack at the bottom, that's when you get those 2007, 2009 kind of pullbacks. The credit markets are always the first early warning signs that something big is about to happen on the downside or on the upside. So yields going higher, prices are falling. So if you're a bondholder and you basically bought here, let's say the price, I'm giving you a simple example. Let's say the price of the bond was $10. Okay? And you locked in a yield of 1.495%. Now the yields have gone up to 1.77%, but you're locked in at 1.5%. Now, what do you think is, I told you the prices are inverse to move opposite to yields. So you pay $10 for the bond here. What do you think the price of your bond here is roughly? Jen. I'm giving the answer, so somebody please answer. And not Mike. Jen, I want you to just get it. I just told you, price of government bonds fall. You pay $10 here. When so yields are rising. So yields have risen from 1.5% to 1.7%, almost 30%. But you are still locked in the rate. It's like buying a house. You're locked in at that rate. You can be like, oh, rates are lower. Let me just change it tomorrow. No, you got to go refinance it. You have to redo your mortgage. No. So basically, you pay $10 for this bond, at 1.5%. Yields are at 1.7%. what do you think happens to the price of your bond? I just gave you the answer.
It's going to go down.
Exactly. Exactly. Now, if you're an investor and your stock has gone down from $10 down to $3, I'm just giving you a hypothetical example. Are you going to be like holding it forever? Are you most probably you're going to take the loss and say, that's it, I can't take it, right? Because you've lost about 70% of your value. Do you understand what I'm saying? So the bond guys who there's a lot of this dumb money, including mom and pop dumb money, who went and sat in the bond funds. They still are. When they get their statements, they're going to see the value of their bonds down. And they're going to say, first thing, they're going to call up their mutual fund guy, who's not their broker, or call up their broker and say, what the hell? You just told me that this would never go down in value. So can somebody answer me why they say that a U.S. government bond does not go down in value? Only if what? This is important, guys. You guys are traders. You should know this. What? Go ahead.
Held to maturity.
That's right. Held to maturity. So if you're a 10-year bond and you put $100 in here, let's say you put $1,000, you got to hold it for 10 years. And if you bought it like an idiot at locked in a rate of 1.5%, that means you paid 1.5%, which is at net actually a negative return because of inflation. Don't want to get into that. Okay, if inflation is running at 3% and you're making 1.5%, that means you're losing on 1.5%. Okay, so $1,000, yes, you will get your $1,000 back 10 years later at maturity. But in between, if you try to sell it, you might be down. So when they get their next statement, so the people who bought it over the last 2 months, or even this month, they're going to see their $1,000, just hypothetically speaking, maybe 800. They'll be pissed out of their minds because mom and pop have no idea that bond prices can go down over the short term if they don't hold it to maturity. So what's their first emotional movement? Get me out of that. So the mutual fund guy's going, where do you want to go? Well, stock market's doing well. Let me get in there. Looks like everything's safe. It's safe to go in. Boom. That's the last stage of the market move. Wave 5. And you get a 1,000-point correction. Happens like clockwork. Jen, did you understand some of these things that I explained?
Yes, I do.
Okay. This is what they teach you in senior level at Princeton or my old school Boston University or MBA classes. This is what they teach you guys, okay? You get this here for a puny couple of dollars a month in 10 minutes, all right? Seriously. And even so many people have no idea about this concept that bond prices can go down, that the value can go down. And mom and pop are never happy when they see their bond prices go down. So there will be a shift. And even hedge funds and stuff who are sitting in there, they all have a threshold of pain. If they see the billions of dollars sitting in a 10-year government bond is starting to go down by, let's say, 20%, you think they're just going to sit there? They'll be forced to move. That's part of their mandate. So saying all that, simple English, guys, bond deals, this is a dragon bullish formation. This is Jen's favorite formation, right? Dragon bullish?
Yes.
Yep.
Yes, double bottom.
This is your major neckline. Now I'm going to let you know the secret that you're going to hear in CNBC in 3 months' time. Write that down. You're going to hear exactly. What are you going to hear? I'm going to tell you beforehand what you're going to hear. Okay? So bond deals are now going higher. Markets like it. You have the first neckline here at, let's put a figure on it so we can track it. As you can see here, these are the same identical patterns that we follow in stocks, and we try to predict the move prior to them happening. Let's do this left. It's 1.9%, right? So 1.9% is going to be a first major resistance. We're not there yet. We are at 1.78. Okay? So roughly 1.9%, maybe a little bit more. There you go. Yeah, 1.907 is going to, and there's a gap fill here. See the gap? Is everyone seeing the gap right there?
Mm-hmm.
The dotted lines? Right. So just like a stock, you can, I'm just showing you the predictive nature of this thing here. So bottom line is we are inside the gap right now. It's going to go to the upper end of the gap and boom, hit this massive downtrend line. This should be made like this. It's a massive downtrend line. If it breaks out above that, in my opinion, I think it will. Looking at the pattern symmetry and what's going on and the overall phase 1, phase 2 deals with coming with China, there is And I believe the European, I don't want to get into this, but the European bond markets are going to move away from the negative yield situation that many of them are in into positive yields. This is all going to be a big tailwind for equities. Big tailwind for equities going into the first quarter of this year, which is the next year, which is March. It's my prediction. And I think I'm going to be right. I was right last year and the year before on these broad predictions. In between, there's going to be choppy volatility. But the key is when you look at the first neckline, we're almost there. That's going to be a first level of market hitting a extremely technical overbought condition, which is probably going to be in the 2050, 2070 range on the S&P 500. At that point, we will have at least a 2% correction. We should. And we'll take full advantage of that. Everyone's going to scream and shout, say, I told you, it's not going to go. Right. You're going to buy that 2 to 3% correction. Maybe you get a slightly bigger correction for whatever reason. Could be the Brexit situation, which is a big mess. Could be another black swan event we don't know about. Okay, out there. Unquantifiable event that just hits us. But that will most probably come off bond deals hitting around this level and the S&P 500 hitting 2050, 2070, possibly 20. What am I saying? 2050, 2070? And none of you guys corrected me. I mean 3050, 3050. Maybe an overshoot to 3100 as some macro quant short hedge funds get really decimated. Okay, so short squeeze. So that would most probably happen of these levels. Now, this is the major neckline at 2.1%. Markets approach 2.1%. I'm sorry, the 10-year government bond. All of a sudden, you're going to hear on CNBC, Bloomberg, Fox Financial Network, and any other talking head out there. All of a sudden, they're going to be talking about, oh my God, this is a runaway. Now inflation is going to come back with a vengeance. Bottom line is, at this point, if the bond deals hit 2.1%, they're going to be comparable with overall stock market yields. There's going to be parity. So if there is parity, if somebody's telling you you can buy an S&P 500 dividend at around whatever, 2 to 2.5%, and you can buy a completely safe, never defaulted ever U.S. government bond at 2.2% or 2.1%, there are value managers out there who are going to say, you know what? I'm going to sit on a no risk, zero risk asset quality, earning the same dividend yield than if I had to play in the risk market, which is stocks at 2.2. In other words, the market will be fully overbought. Where that level is, it's tough to guess as to where that level is on the S&P 500. Maybe 3,100, maybe a little bit more. But we shall see. That's enough for bonds, all right? But this pattern we like. We have played this on stocks all the time. It's going to come here, probably going to create a quick handle that will be your 200 to 400 point drop in the market. We get 200 point drops in the market anyway, maybe a little bit more, and then a attempt to move up to the 150-day moving average. Remember, these are all downtrend lines, ladies and gentlemen. These are all downtrending. So first we need to break out over this massive downtrend. It'll be a big, big boost for stocks. And God help us that if we go above this, then the markets are going to start worrying about massive runaway inflation because the Fed just basically gave us so much juice to play with, i.e. interest rate cut. You know, there's always a kind of consequence to this. But that's it. The pendulum is swinging back, what we call mean reversion. It's reverting back to the mean. We have a 3450 crossover on the 50. That means bond deals are going higher. I told you bond deals were going to higher right when these stochastics turn. Feel free to look at my my videos on YouTube as well as on the real-time Twitter post, which I told members, like, this is a good sign the markets are going to go higher. Internals are good. Okay, enough of bonds. Let's take a look at some long-term charts on the overall market, which will keep your head glued to the fact and not scared under the bed every single morning that you wake up and futures are down 10 points. First and foremost, this is your actual E-mini live chart in action, Globex markets. These are megaphone patterns, consolidation channels that I predicted and showed you guys, walked you guys as much as possible over and over again. That is exactly what's getting played out right now. So when you look at this chart here, we have a very large rising wedge that goes all the way back to November of 2018. right? And then the Christmas Eve massacre right here. So this wedge actually started because there was a point of reference here. There was a point of reference here. It actually could be created within reason after Christmas and as the following months. So when you look at this chart here, Jen, okay, because you're in the process of learning all these technical stuff. I'm asking you, when you look at this chart here, where do you think the max upside is? All the internals and everything are fine.
Upside?
Max upside, maximum upside, as per this chart. Come on, this is not rocket science. It's staring at you, Jen. Please make it quick.
3,100.
Thank you very much.
Mm-hmm.
Faster you think, the better you're going to do. You did excellent. 3,100. Just your millisecond speed and answer should be like 1 millisecond instead of 5, all right? But you still get an A+. Absolutely. Good stuff. 3,100, max upside. Nice round number. You don't think we can get there? Yeah, we can get there. So one thing at a time. What's the next first initial price target that you're seeing here on the E-minis, aside from the max upside? Go ahead, Jen. Attempt.
The first target is going to be.
I mean, no one's asking exact, but what is a reliable target to go by? The upper Bollinger right here.
Okay.
Around 30.50 on the E-minis, all right? Exactly. Now, by the time that we move all the way up towards this range, the standard deviation from the moving averages, which have worked flawlessly 100% of the time for us, is the 34 and the 50-day moving average. Orange line, as you know by now, for pumpkins, is the 34-day moving average right here. The red line is the 50-day moving average. So by the time we move all the way up here, the distance traveled from the highways gets rather extreme, what we call large standard deviation, i.e. market technically severely overbought. Doesn't matter what the good news is out there, the market will correct. And that correction, like I said, is going to be 2 to 4% from those levels, in my opinion. The further we get away from this, from the moving averages, obviously that means we're getting technically really overbought. And everyone's going to be feeling a little too good because they're coming in late, like, oh, the market's definitely going to go higher. You're going to hear the idiots, some of the idiots on all the financial media say, oh, it looks like it's really safe to go back in the markets right now. And bang, markets are going to fall. I haven't been wrong on this, guys. The sentiment is you're going to start to feel good a little bit. The minute you start to feel a little good, you got to move more into cash. Biggest money is made when you're feeling crappy, not when you're feeling happy. All right, you can write that down. Pluralistic trading mantra. The biggest trades in your life you will make, which will enhance your self-confidence, your net worth, your trading account, are the most scariest, crappiest trades you take because of technical reasons. And the happy trade, the happy stuff, by the time you get a little happy, you're going to turn crappy. Happiness is crappiness when it comes to the market, all right? Always be alert. Now, there is something here that I saw today which kind of blew my mind. So I'm going to show that to you on another. So this is looking good. This is the daily chart. And also another way is, my neighbors, sometimes I bump into them walking the dogs, but these guys are like big shot network engineers. That's a guy from Canada. And then a couple of other business guys. They always say, hey, Frank, what do you think the market's going to do? I said, the market's going to go higher. I said, when was the last time you put $100,000 in the market, buying stocks, not your mutual fund and stuff? Oh, man, it's been a long time. Exactly. Keep on doing that, and the market's going to keep on going higher. I said this to guys like 2.5 years ago. He still laughs when he meets me out there walking on the dogs. And this guy's loaded. Okay? He could drop $100,000 on a stock in 2 seconds. No problem. And he hasn't bought a single stock. Yeah, he bought a couple of little stocks. You tell me, all right? Now, this is a very wide range, guys, right? So if we break out of this range, a lot of quant systematic short funds are going to cry uncle. They could be put in Gitmo. All right? Waterboarding. Waterboarding in the financial world is called the short squeeze. And I believe some hedge funds and stuff is about to get waterboarded. They have been lately. They have been since the market turned. We called it October 3rd. All right? So that's one of the reasons, Paul, why the market still has room to move higher. Now, saying all that, this is a very wide range. And once you get and some technicians lately have been saying that a monumental move on the market's coming. That is known as phase 5. That is the phase where everybody gets a little too happy because they're finally in the market. It's an Elliott wave theory, and it mixes with behavioral game theory and behavioral finance as I use in my modeling. So that big surge towards 3100 will be that wave 5. But wave 5 can continue longer. All right? Because 3100 means we have another 800 points or so on the Dow. Enough said. I think that's clear. Let's take a look at this. And this is something that is off investing.com. Very easy on the eyes. This is your same daily chart on the E-minis, but something I noticed, and I'd like to see if you guys noticed it too. So I want you to focus on this. I'm going to walk you guys through this. Obviously, this is the same chart, and this is very exciting, guys. So drum rolls and everything included, and puppy howls. All right. This was one range that we broke out of. We came down and did the job, and this is where we are now. When we talked about it this morning. Now you can clearly see here, I call it the Texas bullhorn pattern. See, Texas bullhorn, Google it up. It looks like that, right? It is the Texas bullhorn pattern, which goes to 3050. Now, something else, and this is real technical reading, and like I said, I share, there's no secret magic. Yeah, my secret magic is my brain and my hunger to do better. But, you know, some services say, yeah, we have a method, you know, if you follow there's a formula. There's no frigging formula, but there are certain ways of looking at things. So let's see if you guys, and I'm already giving you the answer. I'm showing you where you need to look at. Look very carefully in this area. Just because a pattern is going higher doesn't validate things. The internals have to cooperate. This gaping, these two lines racing forward like a gaping mouth, you know, like a fish, like a mouth open, like a shark with its mouth open, is scary. Is really scary for hardcore shorts, not tactical shorts like us time to time. For hardcore shorts, they're like, oh Lord, look at this. Look at that. It's surging. Not forever. Till we get to those levels we talked about. Maybe till the end of the month, first part of November. Then we correct again. But here is something that but you have to mix in this with what's happening on the external picture to make a determination. So if that's the case, what else do you notice here? And I'm making this bigger. That is extremely bullish. And please focus. I'm going to zone it down. Please focus on this. This is good. This is good. So we're good. Focus here. What do you see here? And I'll give a hint. I just talked about it literally 2 minutes ago. What is happening here, which is extremely bullish for the markets after a long time? Come on, don't take all night. If you don't know, say, hey, I don't see it, and I'll explain it. Jen, Mike, Paul?
Yeah, I don't see it.
Okay, good. Paul, do you see anything here? Very powerful.
No, nothing
stands out, right? Okay, great,
yeah.
great. Okay, nothing stands out. Mike, same story, right? Nothing stands out, right?
Sorry, I stepped away for a minute.
Okay, no problem. I'll answer it. Guys, this is what spotting technical patterns, spotting technical lines is all about. So I'm going to show you. It stands out big time. Big time. I'm going to give you another chance. What stands out here? What's going on here? And I told you to focus on this area. What's going on here? What's going on here?
Top.
No, there's no double top here. This is what's going on, okay? The acceleration of the 50 and the 34-day moving average, it is moving now at almost a 40-degree angle. Before, through all this mumbo jumbo, it was moving sideways to down. And the last time the 34-day moving average started to accelerate, so did the trajectory turned into a 45-degree angle. The market surged hundreds and hundreds of points back towards the highs. Okay, so what you should have noticed, and I don't blame you guys. You guys don't watch charts all day long like I do. Look at the sharp movement just within the last couple of days. It just went. It was going kind of, and then boom. Telling you all the factors behind it. I explained to you. Limited flows out of the bond market as they start to get hit. Positive vibes on the trade deal. All kinds of good stuff. Companies, 70% of the company's earnings, if not more, are beating the lowered estimates. So this is big. This is big. And I just noticed it tonight. Now, if you flatten the chart, it's hard to really see. I noticed it and I looked at it, zoomed in, and I said, wow, this triple top, it's actually a triple top, Mike. The triple top needs to be taken out, and I believe it will for reasons I just showed you. So there you go. Now you see it, Jen, Paul? This sharp.
Yes.
Like all of a sudden, it's just starting to take off. And then at one point gets really overbought. But the last time we saw this was here, and the market went berserk, and that was back in back from the lows in March of 2019, and the rally literally continued nonstop till June, 3 months. Not March, June 3rd to June 24th. I think June is repeating itself. The month of June is repeating itself. Then they pulled back for 2 days. Everyone was like, oh my God, so scared. Said buy. And the market basically went higher. So this is pretty serious stuff, guys. Now let's move back a little bit and look at the daily. This is the weekly. That was the monthly chart, by the way. Oh, I forgot to mention. This is the monthly chart I was showing you guys. No, this was the daily chart that I was showing you guys. Okay, so the daily chart is very good. The weekly chart is shaping up here, shaping up nice. Again, all pointing towards that 30, 50, 30, 60 level before it hits a mini roadblock. Now, based on my charting, which I did months ago, long-term forecasting, I drew a uptrend line all the way touched the peaks of these triple top on the market. You bears always keep on saying, oh, it's the bears always say, the hardcore bears always say, market's at a double top, market's at a triple top. Not talking about you, Mike. I'm just saying in general. And yeah, till the top gets taken out in an ascending triangle, bust out move. So when this line, which goes all the way back right there to what month? Goes back to the beginning of 2019, February 2018. I'm sorry, February 2018. All right. So this uptrend line is at 3,100. Yeah, 3,129, 3,130. So that's what it projects out to. And we have a extreme projection that the markets can go to 3,100, 800 points higher from here. You got that phase one deal done in November, markets will hit 3,100. Why not? Now this is wild. This is a chart that the bulls, if they know how to read it, would be like salivating over, drooling, Pavlov syndrome, right? You guys know Pavlov syndrome. Or the bears are going to be like, nah, this is it doesn't work like that. No, it doesn't work like that. Sure. That's why 90% of investors have stayed out of the market 90% of the time. Okay. So what this monthly chart is showing you that we are about to, this goes back from 2007, ladies and gentlemen, October of 2007. So October of 2007 was 12 years ago. This was the bottom of the market when the S&P hit 666. 2009, March 9th. I was at my desk on Wall Street. Okay. And many big shot clients, including some some pension funds, they were like, sell, we can't take this anymore. Sold Apple at like 60 or 70, 80 bucks, and Apple split twice along the way. They could have quadrupled their money. You're talking millions and millions of dollars, you know, small pension funds and stuff. So sad, but what to do? So what is this pattern here? Jen, you're back in the game again. What is this pattern, which is forming right now?
Ascending triangle.
There you go, A plus, an ascending triangle. Now this is a monthly chart, so it develops over months or quicker. So when you look at it one or the other, it does look like an ascending triangle, rising wedge, whatever you call it. But this is an ascending triangle, whichever way you slice it or dice it. This little candle here this was the candle that everyone freaked out on August 1st. This was the one which was a scary candle. Here, the market could have broken and fallen, and I've shown that. We could have come down and retested 2,400, 2,500. I would say, I even showed people, like we would go to 2,683. But we didn't. There was a massive reversal, bullish engulfing candle on the month of June. It saved the US stock markets, ladies and gentlemen, okay? Otherwise, we would have done this. This was like telling us that we would go to around 2,200. That was back in 2018, December. But then we had that massive tail reversal. And this one was no good either. This one was looking to possibly come down and retest 2,400. You heard that on TV and all that stuff. Oh, yeah, markets are going to be down, 2,400. Yep, right. In the meantime, what was it wasn't a trick question, but if you followed some basic principles of the stochastics, this bottom on December 24th, and as it was climbing, oh, this was 2019. We're in 2018, December 24th. As the stochastics they turned around, started to climb, I showed the pattern symmetry of 2015, 2016, 2010, end of 2011. Every time you bottom like this over a monthly basis, you could literally buy things 6 months out and not look at the market. But is it possible for me? No. So I'm forced to be in the market, but as a long-term investor, you want to look at that and say, you know what? This is what's going to happen. But in between, the markets gyrate. So we had these big fat corrections, but the stochastics kept on climbing higher. This, as you know by now, is a inverse head and shoulder, head. So you can even draw patterns on internals. So this is telling us the market was going to go higher, regardless of daily fluctuations, weekly fluctuations, regardless of blah, 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 blah. So now we are approaching some pretty severe overbought conditions, but overbought conditions doesn't mean all of a sudden you're going to crash and burn. You could stay overbought for months and months and months and have a monster multi-month rally like we did from back in 2016 all the way to 2018. So we have had multi-month rallies where the stochastics, notice, keep on staying overbought. And even this wasn't that small in reality when it happened, where the S&P went from 2,000 down to 1,600. That's like losing 20% of its value. You plunged, so you bought again. Same thing here. So now it's an ascending triangle. One real push, phase one, phase two. I don't give a crap what the next keep on talking about. I call them US haters. They are. Like, if you don't believe in the strength and the power of the US economy to rejuvenate, and US businesses which truly make America great, not our politicians, ladies and gentlemen, I'm sorry. It's US business that makes our, so if government keeps on attacking US business for whatever reason and goes a little bit nutty, I can assure you the markets ain't going higher. These charts are going to look very different. President Trump has been fantastic for U.S. business, losing regulations, losing bank conditions on Sarbanes-Oxley stuff, removing it, blah, blah, blah. But at the same time, he's, some of his people and him sometimes, President Trump sometimes have attacked the drug industry, has attacked particular tech giants, talking about antitrust monopolies and crap like that. We don't want to hear that. Remember during Obama time, sometimes they talked about it. It was pure socialism. It was pure hatred. I didn't like it that time. I don't like it now when they keep on attacking our corporations. Okay, I don't care whether it's Donald Trump or whether it's Mnuchin or anybody. You do not. Yeah, you can criticize a little bit, but you start attacking full blast and you threaten U.S. great companies which have which have created millions and millions of jobs here, which most of them have, Apple included. Okay, and more importantly, have put billions and trillions of dollars in corporate taxes in the coffers of the U.S. Treasury, so politicians can go mess it up. That's what they do generally. Both parties, to be honest with you. So Democrats worse than the Republicans. And then you basically tell them that they're a bunch of morons and they should be broken up. Yeah, right. It's real smart. Last I heard, that's what communist dictators did. That's why Russia fell as an economic superpower. We leave our free enterprises to themselves, and they have a self-mechanism system of correcting themselves, or the stock market will correct the valuations of those companies. Government should not be involved in U.S. business whatsoever, ever. Loosen the regulations, make it healthy. President Trump does a great job in that. The negative part about it, which Wall Street hates, U.S. business hates, not just Wall Street, is putting too much of their grubby fingers and their mouths into the daily running of U.S. businesses. Not acceptable. We're not a communist socialist nation. We're pure capitalism, innovation. End of story. That's my speech. All right. So vote for me now or take a walk. Just kidding. All right. Ascending triangle, Jenny. If it breaks out, we could go into about 3,100 plus. This is the longer term chart, looking damn bullish. President Trump plays his cards right, as he is certainly doing. We are going to go on a multi-month rally, which will culminate in March of 2020. That's all. Questions? And make it quick, please, because I go to sleep. I'm going to bed early today. Stocks. What's the stock you wanted to see, Paul?
We're going to know about Apple pretty soon, but that's the stock I'm watching right now.
Okay, sounds good. So let's take a look at Apple. You own an iPhone?
My wife owns all the Apple products. I'm an Android guy.
Okay, sounds good. Good for her. I'm a big supporter of Apple products. Android, which Android? Like what make?
I'm actually running a BlackBerry Priv on Android, and I love it.
Which one?
Keyboard. BlackBerry Priv.
Okay,
not a lot of people know about it, but
just so you know, we have a lot in common because I was a very late adopter of iPhones. My son was, my wife, they started buying iPhones right when it came out. I used the BlackBerry. I still have the first BlackBerry edition, the one which was the touchscreen one, the one which was the swipe feature that Apple finally adopted just last time. You know what I'm saying? The swipe thing. You know the one I'm talking about. I still have it. I have almost every single BlackBerry from day one, other than the really chunky one from way back. My wife's like, what are you gonna do with this? I said, I'm gonna put them in a museum, honey. I'm gonna put them in a museum, and I'm gonna force people to look at them because they were the pioneers of the ultimate cell phones. They were the pioneers of encryption security. Waterloo is where they have those server farms. I've passed them many times. My brother-in-law's from Waterloo, right? And that's all these black buildings. They look like Area 51. That's BlackBerry. BlackBerry is so amazing. Only reason I left BlackBerry is because they have no apps.
Yeah.
They have no apps. So, I'm running my whole business off my iPhone sometimes. I don't use laptops anymore. I have 2 iPhones, and I want them to make bigger and bigger screens. I want to make them such a huge screen that Samsung goes, what? No, really, I want bigger screens. I want a 9-inch screen. I'm wanting little, like the Samsung ones. Samsung screens are amazing, even though I was pissed on Samsung, they're great phones. But the apps, no one writes apps for BlackBerries. I said, I got to go. What can I do? Yeah. I couldn't read the news properly, blah, blah, blah. And then all of a sudden, my world changed. So, but they're fantastic phones. They're like the manual driver's cars, the race cars, high performance cars. No fancy stuff, but lots of good stuff, but you feel the road. Problem is, no apps. It's good for you. All right. So this is your Apple. It's simple stuff I'm reading. No problem here. No problem here on the McClellan oscillator, New York Stock Exchange McClellan oscillator. No problem on the full stochastics. Absolutely no problem. This is surging. You know, this is just like the 50 and the 34-day moving average. Apple's a major component of the market, surging. Okay, very strong histogram volume showing strong underlying strength. No dips, just moving along. So all this is good. It's a 666. Whoa. Now, simple stuff. This chart was drawn a while ago, so I am going to just adjust it a little bit. Thanks for bringing up Apple. 253, and at some point, 280. These are very structured lines. I believe on earnings, Apple will be at 253. And every other metric will get overbought. So yeah, 253, that's what I'm looking at. There's nothing here. And remember, when you're looking at candlesticks, it's not just some fancy little boxes, red and blue. It's showing you the liquidity, the money flow. Everything is being encompassed in that candlestick. That's why I never use point and figure charts and stuff. Because I love looking at visual stuff. Like a child could probably grasp all this better than all of us and trade better. Like you could see what a beautiful candle this is this past week, on Friday. Forget even the weekly one. We're going to look at a weekly. So it's just easy to read. Now, the further it's moving away from the 34 and the 50 is telling us that it's getting overstretched. Will Apple completely drop a bomb on us? I don't think so. No, I don't think so. And if it does, buy it. Apple is on a long-term, multi-year trajectory of going higher. There's nobody comes close to Apple. I'm not talking about the phone part. There are phones better than Apple. Samsung has great phones, you know, the BlackBerry. But BlackBerry is a no-name because it's not. Nobody buys BlackBerries. Nobody even supports BlackBerries here anymore. I might just buy one for fun now that you've told me. It's the latest one. What's it called? BlackBerry what?
Well, it's running Android and it's got a keyboard. It's called the Priv, P-R-I-V.
Okay, my brother-in-law still hasn't left his BlackBerry. Can you believe that? I'm just like, what? He's like, he doesn't say anything. He's just still, text message coming. Oh, from my BlackBerry. Like, okay, great.
Yeah, that's the stock I don't want to see. The chart of.
Exactly. So
Yeah.
it's different. They're basically a software company, just making phones just to keep the software going, you know. So, but even then, all right. So let's not talk about things we don't own. So this is good. So we're looking at 252, roughly about $10 from here. Let's take a look at the weekly on Apple, longer term picture. The weekly is also very bullish on all fronts. All fronts very bullish, guys. And remember, Apple is a huge component of the market. Apple goes higher, market goes higher. All right, that's it. 260, 280 tops. These are very defined lines right there. Broken out. Like in the old days, technicians just went with what they saw after it happened. These days, you got to be a little bit early because the algos are kind of all, they know what you're seeing, so they're in the business of demolishing you, right? So in the old days, they would look at it and say, wow, this is a multi-year range breakout. And if you really want to be bullish, you say the range is 140 to 230, let's say, right? To 140 to 230. Let me see. Yeah, 140 to 230. So $90. So in the old days, pack of the napkin calculations, they would say, you know what? Yeah, over the next couple of months, because these are weekly charts, multiple months, Apple's going to add 90 to 230. What's 90 to 230? 420, right? 230 plus 90 is 420, Jen? Nope, it's not. It's 320. I don't know why I was getting confused. 90 plus the range breakout at 230 is 320. So let's see how we arrive at 320. I think I'll be able to draw a technical line to show that old-fashioned back of the napkin thing. We can go to 320. Let's see. Drum roll, please. Whoa, close. 302. 302. All I did was go back a whole bunch of years and so that's a longer term picture. Apple, in my opinion, if you really want to project out, let's say 3 quarters from now, whatever, can go to $300. Trust me, the service revenue is bombastic. Everything, it's like solid. Is everything great? Are this iPhone sales going through the roof? No, but the new iPhone sales supposedly are going through the roof. The new cheaper version. I still have to get the newer one. I always get the newest one, but not this time because these two are so fantastic. The last ones. So okay, so there's your Apple. Jen, you don't have any stock in your head that you want to see?
No, you went over them today on ACS.
Okay, and then I talked about the other stocks, the thing. Let's take a look at Facebook, another major player in the business. Facebook stock is more structured, so I'm going to look at the other. Let's start off with the daily chart. Why not? That was the last major fall in Facebook. That's why I had the trend line, uptrend line from here. So this is Facebook. And Facebook's Instagram stuff is going nuts. They're making so much money. That's the best investment ever. Do you know how much they bought Instagram for? If I remember correctly, they bought it for $100 million. You know how much it's worth right now, just in enterprise value, if they spun it off as a separate company? You put $100 million in buying a small Instagram, startup, and Facebook bought it and made it Facebook. What do you think it's valued right now? From $100 million. It's like putting in $100. It's worth $14 billion. You talk about smartness.
Wow.
And all they do is piss on Mark Zuckerberg. So sad. Then these senators ask the dumbest questions in the world. Like he's like public enemy number one. It's so pathetic, these guys. These old farts sitting there, stealing money from US taxpayers, and they question guys who have created monsters and change the way technology works. It just saddens me. It just saddens me. All for political reasons, from both sides. So sad. And Zuckerberg sits there like a stone-faced guy because he's got to kind of run those and he has to answer these dumb questions from dumb people. That's how I feel, right? So you know my feelings. Stupidity is rewarded only in one place in the world, in government. Nowhere else, but stupidity and hypocrisy and all kinds of lies is only rewarded in politics. In government, all governments, US government, every government. Seriously. Instead, brains should be rewarded. I think all of you agree with me on that. So let's take a look at this. Where do we go? This is where we go. I believe the stock on a fast move higher will first hit, obviously, 192. That's a given. This is starting to pan out like say it, Jen. Just make it happen quick.
Dragon bullish.
Obviously. The first level of the Dragon bullish level is 192. The next level is 200. The next level is 205. My opinion, for as a trader, I got $10 in my pocket on this trade. If it pulls back a little bit and still stays above the 50-day moving average and above one's, let's say after hours, the stock plummets down 12 points, hits this uptrend line, right? Hits this second uptrend line. This one second. I'll buy it. I will buy it. Let's draw this. There you go. I love the way these charts shape up. It's got nothing to do with me. It's like everything is so algorithmic. Everything is so high frequency. Look at how mathematical these charts are. Keep your emotions in your back pocket or flush it down the toilet. Let's adjust this a little bit more. No, I like this better. Okay, stock. Yeah, this is where it's going, in this zone. And if it breaks a move, it's going to hit 220. That's like Tesla, decimated $3 billion worth of dogmatic, bearish, short, Elon Musk hating guys, hedge funds, in one single day. That's history. But then it's plummeted too like that sometimes. So it's, but they got killed. So yeah, so that's where it is, Facebook. Anyway, guys, it is 9:50 p.m. and did we start at 9 p.m.? No, we started at 8:30. I'm like, wow, I'm so proud of myself that I actually ended the session in 50 minutes. Then I realized, no, we actually started at 8:30. So that means that we went hour and 20 minutes. Good enough. I don't want to bore people anymore. A lot of money to be made. Be involved. I've explained everything. Lots of good stuff. Got to follow the Twitter feed. Follow Instagram end of the evening to see some highlights of the options trades. Get referrals. Improve yourself constantly. Like I put it out there. This is what I'm going to leave with is this. Because this is the truth. Not this guy's goatee, but I'm talking about this. All right? Just remember that when you go to bed. You're constantly learning. Nobody has learned everything. And even if you learn everything, there's going to be something new to learn. All right? And this is serious. When you don't really truly care what the F anyone thinks of you, which I really don't, you have reached a dangerously awesome level of freedom. Never forget that. And that applies to traders. And this, ladies and gentlemen, is the ultimate truth. Only surround yourself with people who lift you higher. Confidence. Let's go to work this week. Good night, guys. Paul, thanks for joining us. Pass the word around, and see you tomorrow. Good night. Mike, take care of yourself, sir. Jen, give all the rescue doggies big hugs from us. Good night.
Thank you. Good night.